one sector that has been making strides right now is the real estate sector. What is interesting is the sector is facing significant headwinds, with the Nifty Realty Index falling over 5% in the last 1 month and down nearly 14% in the past 1 year. But if you talk about the pre-sales data that has come in with regards to the first quarter of FY26, probably that is telling you a slightly different story from here on. Let's get Anushi with the full breakdown in terms of how was FY25, what FY26 has in store, and what should investors look at. Anushi, over to you.
Right. So for FY25 and FY26, we are looking at differential trends in some of these key metrics for the real estate companies but let's break this down on what's happening with the index so far. Now, as you know, we just saw that there has been a downtick in terms of the last 1 month or 6 months and the year-to-date period as well. About 14% of a drop in the last 1 year is what we are looking at. What is leading to this kind of a street concern is something that we should be watching out for. Firstly, the broader industry pointing to an overall decline in the residential demand is something that a lot of these analysts are now suggesting. In fact, if we are looking at the prop equities data also, they are looking at a 5 to 6% of a decline in terms of where the residential sales are going. Concerns also remain on the pricing growth that we've seen, especially after the post-COVID period. Now, we have seen a double-digit growth in the last 2-3 years or also, which is now stabilizing, and this is a particularly bigger concern that we have looked at the NCR region, wherein the price appreciation had been on the higher side. So the demand side of scenario, we have seen a couple of luxury projects as well now reflecting or talking about the commentaries as far as the price appreciation levels go. So that remains as a concern as well. Even in terms of the bookings that we had seen in FY25, it was rather a lackluster year as compared to FY26. Approval delays were some of the concerns that had resulted in this kind of a picture that we had seen. In fact, if you see most of the companies, 87% was the mark that had achieved their overall guidance in FY25. But these are the concerns that have been talked about in FY25, but it's the same reflecting in FY26 is something that we should be watching out for, because if you look at the positive triggers, they clearly outweigh the negative triggers that were weighing on the index in FY25. Firstly, post these lackluster FY25 bookings, robust bookings were seen in the first quarter. In fact, you know, according to Jeffrey, or even the Nomura note that we are seeing, coverage companies are expected to see about a 60% of an uptick in terms of where the pre-sales number are concerned for the first quarter of FY26. Of course, this is aided by spillover of some of these launches which were deferred in the fourth quarter as well, playing into that impact that we are seeing. Higher than expected repo rate cuts also has revived the demand for these mid-income and affordable demand that we are looking at. Now, this is one segment which has taken the most heat or brunt in terms of where the demand has been concerned. So expected rate cuts would aid those mortgage rates also that we are seeing supporting the mid-income and affordable demand. You know, this effect would not play out so much in the luxury demand because it's not a leading indicator there, but over for these two segments, it is in particular focus going forward. Even if we look at the inventory market, inventory levels, that's the unsold inventory levels that we are looking at, they continue to remain at low levels, the time being about 15 to 18 months. So this is again something of a comfort that we continue to watch out playing in for the real estate segment. Approval concerns are also now easing off, which will lead to the stronger launch pipeline also that we are looking at. And we are seeing this impact playing on for some of these counters which are there. This includes the likes of DLF and Prestige Estates. In fact, now if you just look at the first quarter performance, there are expectations that guidance of some of these companies may even see an upward revision. Now, in terms of where the pre-sales growth has been in the first quarter for some of these companies, Prestige Estates, 12,000 crore is the number that we are looking at. 300% is the growth we are expecting from last year. Of course, low base also playing into effect because last year they were not able to meet this guidance. Sobha also, they've achieved about 26% of their guidance. Macrotech continues to remain in line or continues to post consistent growth in terms of where the pre-sales are concerned. Keystone also reported a strong quarter this time. 75% is the number which we are looking at. Signature Global being the only one which has seen a downtick of 15% this quarter. So an outlier amongst this list that we are looking at in terms of where the Q1 FY26 performance has been. But in terms of some of these big launches that we are seeing, DLF right at the top there, Privana North has seen booking of around 11,000 crore, and even the earlier phases which were there, South and West, being completely sold out. This is against the guidance that we have seen about 22,000 crores, so 50% of it already achieved for that. Even in terms of prestige, what we are looking at, or Oberoi Elysian Tower has also seen about 970 crore worth of booking. So that has remained in focus. Prestige foray also in the Puram launch that we are seeing in NCR market has led to about 7,000 crore of pre-sale. So strong launches that we have seen so far in the first quarter of this financial year. So this is in terms of big launches that we are looking at, but just to get a check in terms of how the FY26 guidance is stacking up against what they've achieved so far, 50% and 45% achieved for DLF and Prestige so far. So this is something that we should be seeing, wherein there could be an upward revision to these numbers, while other companies remain on track with their performance, given Macrotech achieving about 22% in this quarter. But let's also look at the street coverage on this, what we are seeing at. So Godrej Properties right at the top. Analysts continue to have a buy call on this one. 16 buys is what we are looking at. 24% of our potential, upside potential is what we are seeing. This is followed by Soba and DLF, wherein analysts are seeing a 14 to 20% of an upside from these levels, buys outpacing the sells that we are seeing. While for other counters like Prestige, it already has seen a significant run up in this last few months. They are seeing about 10 to 3% of an upside. So this is the overall picture that we are building for FY26. First quarter being in particular focus because on the back of these large launches that we are looking at, which were deferred in FY25 due to some of these concerns that we've already addressed.
Thanks, Anushi, for that. That's a good list to look at from here on. And to add to this, Neeraj, you have DLF, which is unveiling the West Park, which will be a landmark launched by DLF Homes in Mumbai as well. So I think that is something we should be looking at. I think tomorrow is when they will be unveiling this one. So the kind of potential that DLF is seeing, and to be noted that this is the second time DLF is looking to enter the Mumbai market. The first time they failed. In a already crowded luxury market, will DLF, which is one of the biggies in the northern region, will they be able to get that entry again in Mumbai, and how successful will they be?
There.
Entry is there. Exactly. Whether they succeed or not is interesting, because first time they failed.
Agree completely, and that to give up that part to Lodha and Low Parel, so could be interesting. Okay.